So guys, welcome to VRDNation. Through this channel, we are trying to educate our fellow investors and traders on practically every topic that pertains to stock market, investing and trading using real life examples, real life case studies, real life trades and a tons of animations, right? So we are trying everything that we can to share our knowledge with our fellow traders. So if you are here for the first time or if you are hearing me for the first time, do not forget to subscribe. So guys, today's topic is going to be extremely important, especially for traders, because we're going to talk about everything we need to know about the put call ratio, right? So we'll talk about what is put call ratio, how is it calculated, how to interpret it, and most importantly, how to use it in your day-to-day trading. All right. So let's get started with the basic question that what is put call ratio? So put call ratio is a very important metric that traders use to understand the market sentiment and more importantly to assess whether the market has become overbought or oversold. Now the calculation behind put call ratio is rather simple. It is basically a ratio of total open interest in the put option and the total open interest in the call option. So let me take an example to explain this better. So the first thing that we have to know is that we don't have to calculate the put call ratio because it is readily available on several websites. Right. So for example, here I'm on sensible.com and you can see that for Nifty, for Bank Nifty, the put call ratio is given here. So currently I can see that for the expiry of 8th of September, it's 0.95. For 1st of September, it's 0.73 and so on and so forth. And you can find similar data on other websites like IIFL's. Right. So here you can select a different expiry, for example, 1st of September or 8th of September, and you can see the put call ratio for Nifty and Bank Nifty. So that's good, right? We don't have to calculate anything, but it's my philosophy that if you're trying a new dish for the first time, you better know what ingredients were used to make that dish and how it was made, right? Just to make sure that whatever you're eating is right for you. In the same way, if you're using the put call ratio for the first time, it's always a good idea to find out how put call ratio is calculated, and it's not that hard. So let me show you. So for calculating the put call ratio, we have to go to National Stock Exchange website and go to the option chain. I'm sure a lot of you are already familiar with that. So this is the option chain for Nifty and this is 1st of September. So all we have to do is we have to scroll all the way down. And here you see there are two values, total open interest for put options and total open interest for call options, right? So let's calculate. Right. So these are the only two numbers that we need for calculating the put call ratio. So let's do that. Right. So I have taken a calculator. So let's just calculate this. So I'm going to put the total open interest of put options as numerator. So it's 11,55,391 and divide that by the total open interest of the call options. So in this case, 15,75,294. And we got a put call ratio of 0.73. Right, so let's just see whether this number matches with the number that we saw on these websites. So let's first start with India Info line. So I will go here and I will select the right expiry, which is the 1st of September. And as we can see here that the put call ratio is exactly matching with our calculation. Similarly, if I go to Sensible and I look at the put call ratio of 1st of September, you can see that it is 0.73. Right, so it's a very simple ratio of open interest of put options and call options. So guys, now that we know how put call ratio is calculated and from which websites we can easily find them, and let's say we got a put call ratio of 0.8 or 1.2, but what does it actually mean? Does it mean that the market is bullish or bearish, overbought or oversold, right? So how do we interpret a put call ratio? So the first rule for understanding put call ratio or any other options based data for that matter is that we have to see them from an option seller's perspective, not option buyer's perspective, option seller's perspective. Why? Because option sellers are more resourceful, they have more insider information and they have much better infrastructure than option buyers. So their chances of being right are much higher. And if you're interested in learning why option seller's perspective is more important than option buyer's perspective, I have explained that in a separate video called Max Spin Theory. So do check it out. So coming back to the put call ratio, if the put call ratio is greater than 1, it means that the option sellers are selling more put options than call options. Now, when do you sell put options? Of course, when you are expecting the market to remain bullish, or you are at least expecting the market to stay above a certain level, right? So if put call ratio is greater than 1, it indicates bullishness among option sellers. So we have to assume that the market is bullish. Similarly, if put call ratio is less than 1, it means that option sellers are selling more call options than put options. Now, when do you sell call options? Well, obviously you will sell call options when you are expecting the market to either be bearish or at least remain below a certain level. So a put call ratio of less than 1 will indicate bearishness, right? So those are the general principles of looking at put call ratios, but sometimes the market can become too bullish or too bearish in a short run, and that can imply that the market may reverse direction for a little while in order to cool down a little bit. So if we look at the historic data of put call ratio, a put call ratio of 1.6 or higher indicates that the market is overbought in the short run, and hence the chances of it coming down a little bit becomes very high, and that's why a lot of traders look for shorting opportunities in such scenarios. On the other hand, a put call ratio of 0.6 or lower indicates that the market is too oversold in the short run and there might be a bounce back in the market, and that's why traders look for long side opportunities. So that is basically the big picture of put call ratio, guys, but there are few important points to note if you want to use put call ratio in your analysis. Number 1, put call ratio can be calculated based on open interest or based on volume, right? So the example that I have taken was based on open interest, but as you saw in one of the websites, it can also be calculated based on volume. So personally, as far as I'm concerned, I prefer using the OI based put call ratio, but it is completely up to you if you want to use the volume based put call ratio. Number 2, put call ratio calculation may not be exactly the same for every website, and that is, I think, one of the reasons why a lot of traders get confused, because they don't see the exact same value everywhere. Now, the reason why the calculation may not be exactly the same across different websites is because some websites combine the put call ratio across multiple expiries, right? So for example, Sensible, it takes 2 months of data, 2 months of all the expiries of Nifty weekly and monthly, and shows you a consolidated put call ratio, whereas some other websites might only show you put call ratio for very specific expiries. Now, the third point to note about put call ratio is that some traders don't like to include far out of money options for the calculation of put call ratio, because they believe that, let's say for in case of Nifty, 1000 point out, it doesn't make any sense for me to include the open interest for that far of an out of money option. So they intentionally exclude those numbers in their calculation, which is perfectly fine. But in my experience, even if you exclude them, the difference is not that significant in the final put call ratio, but you can do it if you want to. And the last point to note about put call ratio is that put call ratio should not be your only criteria for taking a trade, right? So this is something which I have seen that a lot of people do, that just because put call ratio is at 1.6 or 1.7, they start taking short trades, right? But what you have to remember is that the market can remain overbought longer than you can imagine, right? So timing a trade purely based on a put call ratio might not be the best idea, right? So always pair put call ratio with other parameters based on which you are going to take a trade. So that's it, guys. That's basically what I wanted to share in this video. I hope that you understood what is put call ratio, how to calculate it, where to find it, and more importantly, how to use it in your day-to-day trading.